Tax loss, harvesting, what it is, and when to do it. What if I told you that losing money in the stock market could actually save you thousands on your taxes? Today we're diving into tax loss harvesting, a strategy that turns your investment losses into tax savings. Stick around because by the end of this video, you'll know exactly how to use this powerful tool. Hey everyone, welcome back, and today we're breaking down one of the most misunderstood tax strategies out there. If you find this helpful, smash that like button and subscribe for more money-saving content. What is tax loss harvesting? So what exactly is tax loss harvesting? Simply put, it's the practice of selling investments that have lost value to offset gains from profitable investments. Think of it as using your losers to reduce taxes on your winners. Here's how it works. Let's say you bought Apple stock for $10,000, but it's now worth $8,000. That's a $2,000 loss. You also bought Microsoft for $5,000 and it's now worth $7,000. That's a $2,000 gain. If you sell both, your $2,000 loss cancels out your $2,000 gain, meaning you owe zero capital gains tax. But here's where it gets even better. If your losses exceed your gains, you can use up to $3,000 of excess losses to reduce your ordinary income tax. That means if you're in the 22% tax bracket, you could save $660 just from that $3,000 deduction. Any remaining losses? They roll forward to future years. The IRS treats short-term and long-term capital gains differently. Short-term gains are taxed as ordinary income, while long-term gains get preferential rates. The beauty of tax loss harvesting is that losses offset gains dollar for dollar, regardless of whether they're short or long-term. When to do tax loss harvesting? Timing is everything with tax loss harvesting. The most obvious time is near year-end when you're looking at your overall tax picture. December is prime harvesting season because you have a clear view of your gains and losses for the year. But don't wait until December. Smart investors harvest losses throughout the year, especially during market downturns. When the market crashes and your portfolio is showing red, that's actually an opportunity to lock in those losses while maintaining your investment exposure. You should consider tax loss harvesting when you have significant capital gains from other investments, when you're in a higher tax bracket, or when you have highly appreciated assets you want to rebalance without paying massive taxes. However, avoid harvesting if you're in the 0% capital gains bracket. Typically, single filers making under $44,025 or married couples under $89,250 in 2023. For these folks, capital gains are already tax-free. The wash sale rule. Here's the big gotcha, the wash sale rule. The IRS isn't stupid. They won't let you sell a stock for a loss and immediately buy it back. If you repurchase the same security within 30 days before or after the sale, you lose the tax benefit. But there are workarounds. You can buy a similar but not identical investment. Sold an S&P 500 ETF? Buy a different S&P 500 fund from another provider. Sold Apple? You could buy a technology sector ETF that includes Apple. The key is maintaining similar market exposure without triggering the wash sale rule. Some investors use the doubling up strategy. They buy additional shares first, wait 31 days, then sell the original losing position. This maintains exposure while avoiding wash sale issues. Practical strategies. Let's get tactical. First, keep detailed records of your cost basis and purchase dates. Many brokers now provide this automatically, but double-check their math. Consider using tax loss harvesting in taxable accounts only. It doesn't apply to IRAs or 401ks since those are already tax-sheltered. For active traders, be strategic about which lots you sell. If you bought the same stock at different times and prices, you can choose to sell the highest cost shares first to maximize your losses. Many robo-advisors now offer automatic tax loss harvesting, constantly monitoring your portfolio and executing harvesting opportunities. This can be valuable for hands-off investors. Limitations and considerations. Tax loss harvesting isn't magic. You're essentially trading current tax savings for potentially higher taxes later when you sell the replacement investment at a gain. It's tax deferral, not elimination. Also, don't let the tax tail wag the investment dog. Never sell a good long-term investment just for tax benefits. The goal is optimizing taxes while maintaining your investment strategy, not the other way around. Transaction costs can eat into benefits, especially for smaller accounts. Make sure the tax savings exceed any trading fees. Conclusion: tax loss harvesting is a powerful tool that can save you significant money, but it requires planning and attention to detail. Start by reviewing your current portfolio for harvesting opportunities, especially if you have both gains and losses this year. What's your experience with tax loss harvesting? Drop a comment below, and don't forget to subscribe for more tax-saving strategies. Until next time, invest smart and keep more of what you earn. Thanks for watching. Check out this video on tax-efficient investing strategies, and I'll see you in the next one.